Today, we're going to talk about the one chart pattern I think every investor should know. Hi, I'm Matthew Carr, Chief Trend Strategist at the Oxford Club. Thank you for watching this episode of Market Trends. Now, if you're new here, be sure to hit that subscribe button and turn on notifications so you never miss out on my best trading ideas, which I share here each and every week. Okay, so each trader has their own unique approach. If you're a TA trader, you're just looking at technicals, you're focused on charts and patterns. You don't care what a company does or even know what its name is. If you're a fundamentals person, charts are more of an afterthought. You're focused on ratios and growth forecasts. Well, I like to use a mixture of both, especially when I talk about fundamentals. Today, I want to talk about my favorite chart pattern, but not from a technical standpoint. It's a fundamental one. It's also one I consider possibly the most lucrative for short-term moves. It's this. I call this a sawtooth pattern in revenue. And when you see this, you really do have to pay attention, because what does this tell you? Well, first we have a repeating pattern that we see over and over again. This, from a business standpoint, is seasonality. That each year, revenue is not split evenly throughout every quarter, and there is one quarter that accounts for an outsized portion of total sales. Keep in mind, share prices follow revenue and earnings. That means when you have an uneven pattern in quarterly revenue like this sawtooth pattern, shares of that company are going to be inherently volatile because they're going to follow that pattern. A bunch of analysts and Dow theorists and all these believers in efficient market mechanisms, well, they're going to argue, no, the market would even out this fundamental volatility over time. All you're talking about or seeing is random anomalies. But it doesn't, I can tell you that. I capitalize on this pattern in revenue every single year, dozens of times, and have done so for the good part of a decade, winning a number of portfolio performance awards and setting records. But patterns like this, you can use to your advantage, right? You can recognize that, hey, there is seasonality, that the volatility in shares isn't random, it's actually predictable. Now, the other aspect here is, very few companies are an island unto themselves. And what I mean by that is almost all companies in the same sector will have identical or nearly identical patterns to their revenue. So, for example, let's take a look. This here is a growth sector, right? These are all companies that specialize in cloud and AI ops. You could mislabel these, and no one would actually be able to tell the difference, right? This group of charts, these are trucking companies, J.B. Hunt, Landstar, Knight Swift, Old Dominion, right? They have the same pattern in revenue. It's much different than what we saw in that growth sector before. But what we can see here is that business starts to pick up in the second and third quarters, as everyone starts shipping items to stores, preparing for that big holiday spending in the fourth quarter. Now, how about this? This group of charts, these are theme park operators, right? This is a much more jagged sawtooth pattern, right? And so when you're buying shares of theme park operators, you can't really expect them to constantly just move up all the way throughout the year. You have to expect that there is going to be a lot of volatility in shares. And finally, this is the classic one. This is retail. All these companies, again, same sawtooth pattern for these companies repeated over and over again. Now, there'll be some slight variance depending on each company's product mix. But here's the deal. If a company has a sawtooth pattern to its revenue, right, those low periods where business is dead or slow that then swings to these periods where business is booming, generally what happens is that its share price will follow, right? So if there is a 20, 30, or 50% sequential increase in revenue and earnings from one quarter to the next, often there is a double-digit jump in share price over the next few months. So what that means overall is that if a company's competitors all likely have experienced that same pattern, not just in revenue, but also in share price, then we can safely assume entire sectors of the economy, entire segments of the market are prone to seasonality, right? So by recognizing seasonality at a fundamental level, you can exploit that for short-term trading gains. This is why I look at these visuals before I do almost anything else when looking for investing or trading opportunities. Well, I'm Matthew Carr, Chief Trend Strategist at the Oxford Club. Thank you for watching this episode of Market Trends. For more information like this, be sure to go down to the description and sign up for my free e-letter. Until next time, here's to high returns.